By the way, interestingly, you have a big guest coming up, and it's not our own Kate Rooney, but it's a different.
It's so weird.
Rooney.
I was telling someone that, but it's Kathryn Rooney Vera, so it's not. But it is like Kate Rooney. She's chief market strategist at Boltic Capital Markets, and to discuss the role of retail investors, we have Rich Repetto, managing director of Piper Sandler. But Rich, you're going to talk retail investors, but you won't talk meme stocks. So if I talk about retailers today, can we do it, but we can't talk about apparel? Is it? How come you're not allowed to? How come you won't talk about meme stocks, Rich, if you're in retail investing?
Joe, we can talk whatever you want to talk about.
You sure? Didn't say that. It says you're not here to talk about that. Did you make? I don't want to ruffle any feathers, Rich. I want you to be happy.
I'm happy. Whatever you want to do. I'm just not an expert on all these different. I'm focused on watching the retail activity, but not the specific stocks. But Joe will talk whatever you want to talk about.
But it's got to be something that's on your radar. Let me start with Kathryn, because we were talking, Kathryn, earlier about just exactly what I think what you're saying is that the market for about a month and a half has thought, oh, there's going to be a pivot or there's an implied Fed put, and they were going to orchestrate a soft landing. So they're very aware of the first Hippocratic Oath rule, and that is do no harm. But that may have been misguided logic, as we saw yesterday.
I think it is misguided logic. My suspicion, Joe, is that we are in a bear market rally. I think it was wishful thinking and a Fed trying to, or the market trying to bend the Fed to its own will and expecting that this fabled Fed put is still in existence. There probably is some still support from the Fed if the market were to collapse. The Fed would probably scale back the velocity of its maturities, which, by the way, are going to double next month. The market doesn't seem to care about that, but I do. I think that going, to $60 billion in roll-offs on the Treasury front and 35 on the mortgage-backed front will make a difference, and the market doesn't seem to care. I do believe that the Fed needs to paint a stark picture. And I really like what the Bank of England did. I'm not saying we have to say we're in 5 consecutive quarters of contraction, but it's so refreshing, isn't it, to hear a central bank come out and say, this is the reality of the situation, and to get to 2% inflation, we're going to have to see the unemployment go higher and recessionary forces.
Yeah. I don't know. Is it refreshing? It's like, man, we really screwed up. I mean, after 2008, we never normalized, and then after the pandemic, we never normalized. We put the punch bowl out there like drunken sailors, and now they're telling it. That's like the arsonist taking credit for putting out the fire.
Hey, at least they'll gain back some credibility, and I think it would be a positive thing to come out and say, to get back to 2%, we got to get inflation up to the new NAIRU, which is about 4.9%, because I think that's what's got to happen. So what I'm telling investors, Joe, is to position for a real recession, a recession where you see unemployment go from record lows, 3.5%, more towards above 4%, probably 4.5% by 2023.
So, Rich, when we were, and I'm not going to talk about individual meme stocks because I understand exactly what you're saying, but when it was happening and there was all this interest and there was stimulus checks from the pandemic and everyone's playing these things and everyone said, okay, it looks like it could be behavior that long-term is not going to be great for the stock market. But a lot of other people said, hey, we're democratizing it. We're bringing everybody in. It's great, retail. And there was a lot of action. Robinhood, look at all the action. That dried up. And Kathryn, your gut tells you what about that 3,600 level on the S&P? We're talking about June 16th, the worst day yesterday since then. Do we approach that? Do we go through it? Do we not approach it? I know a lot of times strategists don't like to talk about numbers themselves, but do you think we need to make a better low?
I think retail investors that are positioning for new record highs are going to be severely disappointed. And those that are positioning for a Fed that is going to surprise dovishly and only cut maybe one more time, 25 basis points, are also going to be disappointed. This is a Fed that hopefully now has learned their lesson and really is taking that 2% inflation target seriously. So I think the retail investor is going to be disappointed, and he's also going to find headwinds in the form of a collapse in the housing market, and a rise in unemployment. So if we get that, then consumer sentiment on the real economy front also suffers. We have to remember here, really, for me, Joe, it's all about the labor market. First quarter, second quarter productivity collapsing, unit labor costs rising double digits. That, to me, is a recipe for disaster. And we're going to see unemployment rise, economic activity slow, and the market start to price in lower earnings growth going into the future.
Yeah. Kathryn, thanks. Kathryn Rooney Vera, Chief Market Strategist. I'm always very careful here at Bulltick.
Yes.
Bulltick Capital
Thank
Markets.
You, Joe,
that
caution.
is like a minefield. If it's got to mess up 2 letters, and I'm going to be all over the general news.
Don't do it. Don't do it.
No.
Thank you.
And also, Rich, thanks. Rich Repetto, Managing Director at Piper Sandler. Thank you both. I know it's early.